Hi, this is James Shug with Westpac London's end of day report for Monday, April the 30th. And it was mostly a day of negative news and negative sentiment on equity markets. It started off with the Spanish banks, 11 Spanish banks actually, being downgraded by Standard & Poor's, following on from their sovereign downgrade of Spain late last week. We also had confirmed that Spain's in recession. The stats office there reported a 0.3% contraction in first quarter economic output. The Bank of Spain last week had estimated a 0.4% decline, so it was no big surprise, but it's confirmed that there have been 2 consecutive quarters of decline. And in fact, when you take account of the fact that there was virtually no growth in the middle quarters of 2011, the annual pace of activity growth in Spain, Q1 to Q1 this year, Q1 last year to Q1 this year, is minus 0.4%. So already contracting on an annual basis. So Spain's actually meeting 2 separate definitions of recession there. So not only that, we had a range of other news which was disappointing. In the European money supply figures for March, it showed that lending to households and corporates grew at a very slow pace, just 0.6% over the last year, down from 0.8% in the February figures. It kind of suggests that the long-term refinancing operations that the ECB put in place in December and February perhaps may have been credited with just a little bit too much success. Certainly there's no doubt that those operations helped avert a credit crunch, particularly given that interbank lending was freezing up in Europe. However, they don't seem to have, at least yet, boosted lending into the community or indeed boosted economic activity. The slower growth in those lending numbers actually accords with a survey the ECB published last week, which showed that credit to small to medium-sized enterprises in Europe was tighter than it had been in their previous survey. So just a bit of disappointment there. We had German retail sales figures that came out for the month of February, up 0.8%, looks good on the surface, but only the second rise in 6 months. And the underlying story there, particularly over the past 6 months, remains one of contraction. So in February compared to August, the rate of decline in retail volume is actually about 1%. I'm not comparing to a year ago because there was a sample and methodology change just under a year ago, which distorts the annual growth rates there. So disappointing German retail, disappointing European lending numbers, more bad news out of Spain. In the US, we had the Chicago Purchasing Managers Index come out. It was its softest reading since 2009. It fell from, where is it now? It fell from 62.2 to 56.2. Now in 2010 and 2011, that index rarely dipped below 60. So quite a sharp fall in the latest reading for April. And also today, the Dallas Fed Factory Index, it fell from 18 to 11 in April. And the Milwaukee NAPM, or PMI, although it rose 1.1 points up to 52.9, it actually had fallen 7 points in the March survey. So all 3 of those regional surveys, one of them from the Fed, should confirm or add to the body of evidence that points to a slowing in economic activity in the US heading into the current quarter. We had figures on March personal income and personal spending. Personal spending slowed from 0.8% growth in February down to 0.3 in the March numbers. Again, evidence that although there was some strength in consumer spending in the last quarter, it did really taper off at the end of the quarter. Well, slower spending on autos in particular was a factor at play there. Just to correct myself, it slowed from 0.9% in February down to 0.3. So in Canada too, we had an unexpected decline in their February GDP measure. Canadians publish both quarterly and monthly GDP numbers. It seems that mining and manufacturing in particular weighed heavily against the numbers in February. And that's actually the 3rd month in 5 that we haven't seen growth in those monthly numbers. So markets, I think correctly, perhaps have pulled back a little bit in terms of their expectations that the Bank of Canada might actually follow through on its very mild tightening bias that it announced a week or two ago. That's probably it for the main data flow today. As I said, most of it on the disappointing side. In terms of market movements then, we've got in the FTSE in London down 0.6%. This is just heading into the close. Markets haven't quite closed yet. French market's down 1.5% today. The German market down 0.4%. And the Spanish market down 1.7%. The Italians are down 1.2%. They also had some of their banks downgraded today as well. In the Dow at the moment, down about 0.25%. That's the level of the Dow there is 13,194. No major corporate earnings news to report, but the earnings season is still with us, so a few to watch out for. We've got commodity prices here for you. They're mostly down, with the exception being a mild 0.1% increase in copper prices. Looking there at 383 cents a pound. Gold prices are down 0.25% at $1,660 an ounce, and oil's off almost 0.75% at $104.19 a barrel. The Aussie dollar, it's at 1.0407 at the moment. When I started this morning in London, we were looking at 1.470, so it's off more than 2/3%. Just gradually drifted down in line with the deteriorating sentiment in equity markets, the disappointing economic news, and the mostly softer commodity price story. Some things to watch for in Australia, of course. We've got the Reserve Bank's decision coming up. We're looking for a 1/4 point cut in rates. The statement won't necessarily hint at further cuts to come, but certainly we think that a follow-up cut of another 1/4 as soon as June is likely. We've got the Reserve Bank's monetary policy statement on Friday, which might provide a bit more guidance on that front. And watch out too for the house price figures, which the Australian Bureau of Stats is going to release. Their latest quarterly survey is coming out. So some events to look forward to in the very near term, including my return, same time tomorrow.